Good morning, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, March 1st. Welcome to the open of March trade. I'm Michael Boutros, currency strategist with SB Trade Desk. Good to be with you guys this morning. Carlos, Iman, Mark, Mohammed, Pooja, great to see everyone in the room. So, the start of a new month. This is where we always take a little bit more of a side seat, a much lighter hand here as we open up the monthly opening ranges. Look, at the end of the day, guys, I think Jamie said it best in his post. We were a little reluctant to get long the dollar, a little late on that actually, because we were looking for that analog. Remember the analog that we were looking for? We'll go over the implications for that as we open up the calendar month. On the menu for today, DXY, Sterling, Aussie Yen from yesterday, Aussie Yen right at support, Euro Dollar, Dollar CAD breaking the upside, looking for a stretch in 2880s or 2890 rather. Aussie Dollar, we'll take a look at that. Dollar Yen, continue to hold that range. Kiwi Dollar and Aussie Kiwi from earlier this week. If you didn't hear any pairs that you want to review, Pooja says, good morning. I'm short Euro Kiwi. Euro Kiwi from 169.17. Booked part of it at 168.66. Stops at break even. Okay, we'll take a look at Euro Key for Pooja. I got you, Pooja. Okay, as always, like I said, anything that you didn't hear or any questions that you have throughout the course of the session, guys, feel free at any point to throw the message or a question on the message board. So let's jump right in. Quick housekeeping. We do have the midweek strategy webinar today. Sorry about the confusion yesterday. Jamie pushed it back, so he'll be back on the wires today at 11 a.m. So encourage you to stick around for that for a little bit more of a broader view of what's going on in the swing trades. But here's what we're looking at with the weekly charts on DXY. Look, at the end of the day, we talked about the fact that we were getting some divergence, very slight into that low, was key support, the analog that we've been following. You guys have seen this a million times, but just to show you, an interesting aspect is that we haven't really invalidated it yet, but we are making basically a contrary move. So here's the analog we've been following from the 1994 decline. So here's where we're to open the week. Our base case scenario with seeing and how this has been so accurate for the entire 2017 calendar year was to look for another low either at this confluence region here or more importantly 86.75. Now on the decline that we saw in 1994, that last low did see a recovery back, and if we take that analog and put it right on price action, that recovery takes us right back into the low week reversal close from last year. That gives you 91.33. My caution is this. We're just starting the calendar month. As a disclaimer, I'm flat. I don't have any open positions at this point, but we're just starting the calendar month. So it's going to be really critical to kind of sit this part out and see how we open up. If we plow through 91.33, I do think you look for a larger resumption trade near 93.89. But the initial focus right now is if we stretch higher to this key resistance. On the near term, we're at resistance just now, but there is that possibility for a stretch near 91.33. Okay. So the broader picture, a lesson to be learned here, guys. Even after all the years, Jamie, have been doing this, sometimes you fall into that trap where you just fall in love with a specific indicator or a specific suggestive type of analysis like this. And when the market's, telling you otherwise, we have to listen, right? We can't kind of fall in love with our analysis and say, nope, we got to make that new low. The analog says so. You can get caught up in that trap, irrespective of how many years experience you have. So at the end of the day, I do think there's a little bit more upside to go here on the DXY. Here's what we look like on the daily chart. Here's what it looked like last night. The basic premise is the break above the monthly high day close, which was perfect resistance here last week. That was like 90.28. Daily close above that is really what shifted things higher. Okay, so really, at this point, there's nothing to stop this from going near 91 initial level. That's the 2017 swing low. A larger breakout would be in play, in my humble opinion, with a break above 91.33, that low day, low week reversal close. Okay, so even within the confines of just this downslope, you came off support, a little bit of a lowered floor there. reflected off of that median line, came back, 88.27 held for a second time. There's the breach, And now we're looking for that stretch up near 91.33. Here's the intraday chart looks like. So we looked at this last night. Again, there was really no play, guys. There was no new added positions that we can work on as far as the index is concerned going into Asia trade. This thing was trading at the highs. Now, we noted 90, 89, and 91. Okay, this range is sort of the 10 pip range that you're looking for resistance. You have the median line in there at this point for this near-term slope. Remember, we talked about this yesterday. This is the 618 line of that slope. And it converges on the weekly open. That's now your new near-term bullish invalidation is 89.96. Okay, break below that's really what would be needed to shift the focus lower. But as it stood last night, I was still looking for a stretch higher. Now, how do you play this? You're going to sit there and buy at the fresh monthly high with resistance just higher, or are you going to try to fight this against the median line, knowing that momentum is still in well overbought territory? So no play, but we have to recognize the levels that are important. Here's what it looks like now. Here's the 120 exactly like it was last night. And you can see all we've done is continue to hug, press up against that median line. And here's that 90, 89, 91 level. So region of near-term resistance, you could get a kickback off that. Again, pullbacks are to be bought while above 90.11. Remember, 89.96 is the bullish inval. And the break higher, you're looking right at that low day close, again at 91.33. So a little late here as far as calling the turn. Basically we should have gotten bullish with this break as soon as we moved above 90.11. The problem is you never really got a substantiated pullback to be able to offer some sort of near-term entry. And it's, as I always say, guys, just knowing the direction of the trend is just half the game, right? We have to have a viable risk reward. We have to have a viable trade setup to be able to give us conviction to actually pull the trigger. So, while we were looking for this to travel higher last night, there wasn't really much opportunity to get back in. Right now, we're looking for some sort of exhaustion here. Would be reluctant to play this short. Moreover, if the short pulls back, be looking for structural support near 90 on a possible entry to move higher. Remember, we just broke this move, finally broke the February opening range. Now we're in March, but the February opening range finally gave out. So a little bit more upside, I think, could be at hand. Keep in mind, we just got some data prints earlier today. I want to go through that real quick with you. We got personal income coming in at 0.4%. This is for the month of January. We're expecting a print of 0.3, so slightly stronger than expected on personal income. Core PCE year over year, personal consumption expenditure, a good gauge of inflation, came in at 1.5%. That's right in line with expectations. Initial jobless claims coming in lower. Okay, better. So better than expected. 210,000 versus a 225 expectation. Keep in mind that although tomorrow is the first Friday of March trade, NFPs will not be released. They've pushed that back to next Friday. So typically the first Friday of every month is the release of the non-farm payroll employment report. That's pushed back till next week. So we'll have to wait a little bit longer on that. The major focus within NFPs right now is not necessarily the print of how many jobs were created, right? Labor force conditions at this point are pretty much approaching the Fed's quote unquote natural rate of unemployment. The major indicator that everyone's looking at in all these employment gauges is wage growth. And certainly on the last NFP report, we finally got a little bit of a hint that in fact inflation is starting to come into the is starting to trickle down into the wage numbers. And that's really the Fed's main concern at this point. It's not just the headline inflation, but the wage growth. So that'll be next week. We'll go over that. We'll have plenty of time to do that at this point, heading into the monthly open, heading into the weekly close. Watch for a reaction here near term. Broader trade stays constructive above 89.96, excuse me. And if we do get a stretch into 91.33, I'll be looking for a possible reaction here. Okay, I'll be looking for a possible reaction here. Remember, if we take this again to the weekly charts, we also have the 50 line for the current operative slope that we've been in since 2015. The 50 line there comes in right on that same low week reversal close. Any questions on the DXY? That was number one. Got that out of the way. So a little bit, again, the break above the monthly opening range, break above the weekly opening range, break above slope resistance, whatever you want to call it, leaves the focus a little bit higher. So for Euro, that's coming into support, and we'll go over that in a moment. I do want to go over an order that we covered last night, and the other one was Sterling. this was a tough call. You know, I've been looking at this chart for a while. You guys know how we've been tracking sterling like a hawk. And I really didn't want to see this thing break. Market doesn't give a damn what I think, right? At the end of the day, market's going to do what it wants. But we were coming off of a raised ceiling here. We just missed that resistance before pulling back. You saw a little bit of hesitation around the median line. This is the weekly charts. But really, the break lower risks a move on the 2016 high week close. That's the Brexit close from 2016. That's 37.58. Bullish invalidation for the broader multi-year uptrend, still down at 34.94. So the immediate focus is lower, right? We're breaking support. I'll show you the chart in a moment. But that decline, it's important to keep things in context. This whole decline off the January highs is still keeping price within the broader uptrend structure that we've been following nearly 2 years, right? Nearly 2 years. So just keep that in mind. Weekly, daily charts look like this. The level that I was looking at was 37.65 into 37.89. That is a basic 236 retracement from the entire 2017 advance. And then you had the objective February opening range lows. Gives you 37.65 into 37.89. Now add to that a couple of slope features that we were looking at. A, the 50 line for the broader ascending formation that we've been following is right there. Add to that basic trendline support from the late November low. And again, 1 touch, 2 touch, 3 touch confirms right in that same spot. Now on the near-term charts, interestingly enough, we had a nice modified pitchfork off the highs, which was offering some very nice plays, the upper parallel catching resistance. 50 line offering a little hesitation. Once we got the clear, it did see acceleration, then was tagged as resistance. And even within the confines of that pitchfork, you had this near-term descending channel just off the weekly highs, right? And this is why last night, obviously, I wasn't going to just try to catch this falling knife and go long, but for me, the ideal scenario was we would have seen a little bit more of a reaction here and maybe a reset, give me an opportunity to get that play towards 38.55. And then again, into the upper parallel, look for resistance, try to get that short towards 36.75, 36.84. It's the 1618 extension from the yearly high and the Brexit gap. Here's sterling now. Okay, so again, we're right there. You know, as I usually will tell you guys, we want to see a close above or below that key threshold to give us conviction. Well, the close came in at the close came in at 37.60. So it came in just 5 pips below. But, well, it's not a conviction break. It is technically a break. So look for near-term resistance right at former support, right back up at 37.89. Downside levels from here. Initial target would be the Brexit gap. 2017 high close, 35.89, and then bullish invalidation. I don't quite know if we get all the way down here, but all I do know is below 37.90 to start off the session, that's at risk. Okay, that's at risk. Now, if we recover above this region and close today, sure, it's sterling. This thing is known for the throw over, known for the break of resistance and pullback. Could be just a false break of support and a rebound. But at this point, there's no indications of that. The only thing that would be even suggestive of that is if we close above this region. So here's what the intraday chart looks like. Again, you know, you're seeing a little bit of a turn here in price. Here's the chart looked like last night. Dribbled down as low as 37.27. Here's the pullback. So look for resistance again, right at that confluence, 50, the median line of the current slope, the upper basic channel resistance. You have 3 tags there already. So that gives you somewhere around like 30. Basically 38 handle, let's call it. 37.90 is the lateral resistance, but slope resistance comes in right at 38 handle. So look for a reaction there into the U.S. trade session. If that holds, again, you know, there's really nothing to stop this from heading to 36.75. That would be, you know, this last stretch lower into this key support threshold. Again, a 1618 extension from the decline off the highs. A drop into that, like this, would coincide pretty well with a DXY last stretch into that 91.33 level. Okay, I don't know if we'll get it. So start of the month, guys, I can't really caution you enough. Markets have been on the fritz. You're seeing a lot of volatility, obviously, in the equity board. So just make sure that we play it a little bit closer to the chest as we start off the month. And, you know, like I said yesterday, with the volatility that we've been seeing, man, looks like it's here to stay, which is great for us. But we want to be prudent and make sure that we're waiting for our entries on this. So Any questions on sterling or where we stand right now? Could see a little bit more upside, but watch 38 as resistance. And obviously the close above this region would be a little bit of a near-term shift, I think, for the recovery. But that being said, you're still within not only this broader downtrend, but even the near-term weekly trend remains pretty bearish. Questions, comments, concern on British pound? That is number 2. Last but not least from last night was Aussie yen. This was actually a really good play for us this week. It worked out kind of textbook with that final break. Now, obviously, we were looking for this rebound to find a reaction here. This was our near-term bullish inval. Once that break materialized, 83.13 got taken out in a heartbeat. Here's what we were looking at last night. We were looking for that final drop into 82.42. Okay. Really clean formation. You don't get these too often, especially when you're getting all this volatility in markets. It's been very, very clean. The median line has been rock solid. Resistance, support, resistance, a little bit of a run through. But once we found resistance at the median line again, once more, downside parallel comes in right in line with the 50% retracement. Now, this 50% retrace, guys, is the longer term retrace from the advance off the lows that we made in 2016. So if you take that advance, not that extreme swing low, but the subsequent low that we made right here in July, early July, you can see that the 50% retrace converges right on the 50 line. So this is a broader formation. These are two separate formations. This is just using this high right here. A broader formation off of last year's high also puts the 50 line at that same confluence region. Okay, so near-term structure, long-term structure, both highlighting that 82.43 zone. So look, you could see a little bit of a rebound here. Obviously initial resistance, the levels remain unchanged from yesterday, guys. So the initial resistance is still going to be at that former 100% extension. That's 83.13. And as long as you stay below the median line, you have to kind of, you have to still be bearish on this. This would be our near-term bearish inval, as if we break above this parallel right here. Comes in around, what is that, 83.78. Okay. Daily charts. Let me just show you what this looks like again real quick. If we break below this threshold, and Aussie yen is something, again, even on the weekly charts we've been tracking. Here's the weekly chart. This was a big region. We talked about 2017 open at 84.25 as we were breaking it a couple weeks back. And we were worried about this. Basic slope support, right? It's a parallel off the high. Well, at this point, as it stands right now, if markets close the week at these levels, the next major region comes in down here. Last year's swing low, you had a former swing high there in 2016, really nice pivot. The actual swing low from 2015, all of those line up right around 81.16 to 81.90. Okay, on the intraday charts, again, 81.60 is the 2017 low day close. And again, 80.60 into 80.67 would be the next sort of scalp target. That's the key 618. Obviously, the 50 is holding things up now. So, Mike, that's good and dandy. I know the levels. Awesome. How do I play it? Well, from here, the initial focus right now is to the upside. You had some divergence into that low. Price action making a lower low. The oscillator making a higher low, albeit in oversold territory. So a weak signal, but certainly this break here and push through back 30 does shift the near-term focus higher. On this stretch, look for 83 into 83.13 as your initial area of resistance here on this bounce higher. Any questions on Aussie yen? Levels remain super clean on this. We'll continue to track this one. Near-term risk is for a rebound as we open up US trade. Okay, that's number 3. Let's jump into the majors, shall we? Euro, CAD, Aussie, and yen in that order. Here's what euro dollar looks like. So we wrote about this a few days back. I even put out a piece on Daily FX as well. Euro looks like it made a clear, clean, objective break of the weekly opening range. Here's your weekly open. You set a high, you test the low, you fail at the high, break of the weekly opening range, has us looking for a Thursday, Friday low. Initial area was 122.06. That was the objective monthly opening range low. You had slope, and the 618 extension of the decline comes in at, was that 121.22? No, 121.72, sorry, right here. So, you know, again, one of those trades where you never really got a decent rebound to try to get back in after the subsequent break of the weekly opening range, and that's okay. Markets will offer more opportunities. So we were looking for 22 for a reaction, didn't get it, and it continued to kind of dribble lower. This is where we're at now. Here's euro. Okay, we just tagged that area of support. Now, it's worth a bit of a rebound, I think, but look at the weekly chart. Okay, start from the top-down approach. Obviously, we've been following euro for a while. You know, we talked about the fact that we broke above the upper median line parallel, and you know, since the start of the month, that's broadly been support, resistance, resistance. We finally break and gap higher, support, rebound. Once the break happens, boom, we're right back at the 50% retracement. This is of the entire 2014 decline. Decent pivot in price if you look to the left there. So look. Still think there's some downside to go. You could get a rebound off this region, but even if you do, I still think you look to sell that into a lower low. Okay, here's what the euro looks like on the daily charts. Even within the confines of just this, I think we talked about this pretty in depth yesterday. Basic trendline support off that April low of last year was the perfect trendline slope of this low. So it's the exact same slope, both of those levels. And that comes in right at last year's swing high, 2092. So sure, this 50% retrace, a pivot low from back here in January could be a little bit of a bounce, but as long as you stay below that slope, you know, it's basically 2250s, I still think you look for the extension near 2092 on euro. Okay, and again, objective monthly opening range. Yesterday did close just below. Not a convincing break that I would want to chase, but certainly from a technical standpoint, we have to respect it. Okay, coming near term support could get a little bit of bounce. Focus is for a drop near 2092. Here's what euro looks like on the intraday chart. Okay, a little bit more of a reason of why I think you could get a little bit of a bounce here. There's a 618 extension from the decline off the high A, B, C. Comes right in line with the median line that we've been tracking, okay, that we were looking at yesterday. So this is, we hit this target yesterday. Here's a perfect dip. If we materialize with a pin bar here, if we see a little bit more of a reluctancy, some building divergence to begin to the US trade session, sure. Near-term resistance, I know I said 2250, I think, on the daily charts, but on the intraday charts, I want to highlight this region. This is the 618 line of the pitchfork. Perfect resistance. Comes in with the weekly opening range lows. Coincides with that 786 retracement right around 2280. Okay, a downside break from here. If U.S. trade materializes and this thing just sinks, if the dollar index still wants to push higher, you know, 2017 high at 2092, that's the level that we've been looking at in the daily chart. That's going to be the big Bahama mama. Okay. A little bit more of a reaction there. Now, remember yesterday we talked about the fact that if this is a double top formation, okay, which this break does suggest with all fairness, you know, the objective measured move is actually for a dip into 1869. First things first, though, that's the level to break. If you get that there, it's likely to be an accelerated drop. So keep that in mind. There's two key levels here on the dollar index moving forward, or on the euro rather, moving forward. Any questions? Testing support right now, 2172. That's the region you need to be watching heading to the US trade session. Okay, nice confluence region of support right there right now. That's euro dollar going once, going twice. That's number 4, number 5. Dollar CAD on the 28. Okay, yeah, so dollar, I have it written down here for the dollar CAD setup. Here's what the loonie looks like. So we tried this once, we tried it twice. I'm not trying it again. We broke through resistance. Okay, at the end of the day, there's really, you know, there's a nice confluence region there. We tried to test the waters on a couple of scalps. We got stopped out of both of them. If we break higher from here, you know, there's really nothing to stop this from heading right up into the, what is that, 2890s region. Here's what the daily chart look like. Okay, 2892 is going to be the 100% extension. So even if this correctionary, that would be your initial target. Comes right in line with the high day close and monthly open for October. Okay, Just above that's the 50% retrace at 129.27. So you have a nice little range of resistance there on this break above 27.76. Here's what the intraday chart looked like earlier in the week. And again, even yesterday on the pop above here, you guys know I was telling you, I was thinking about, seeing if we find a clip at one of these median lines to try to fade the move. It wasn't worth it. I kept on looking for a trigger, couldn't find it, and thank God I didn't take it because we just continued to push higher. But here's what dollar CAD looks like now. Fool me once, shame on you. Fool me twice, shame on me. The thing is, we tried to short this here, went over all this, right, yesterday. And even on the last break, this was the last region. So here's the breach. And even though we said that, the focus right now is still for a stretch up on 28.86. And that's kind of the level that we were looking at. So breach higher risk to run on 28.87/92. Looks like we're getting tired here. We are getting divergence in overbought territory. So there's really nothing to do here, guys. If you're holding longs, I'd bring your stop up. Excuse me, either trail that stop or bring it up to like just below 128. If we pull back, that would be a nice region that we'd find support before the last stretch. If you're looking for new entries, there's nothing to do here. You either need to see a stretch into 28.90 or 29.70 and a strong reversal, a strong divergent signal, a trigger break, something. I think one of these levels would be an interest for a fade move on a short-term basis. As it stands right now, we're just opening up the month. There is the likelihood, the more higher probabilities to see that stretch into one of those two levels first. Okay, and watch the weekly close on dollar CAD. This is going to be paramount. Here's the weekly chart, right? Watch the weekly close. Keep the weekly close. Keep in mind you have the long-term, or this is the 52-week moving average. We're testing that right now. Just above that 29.27 level. So watch for if we're able to close above or below. This is a rock solid resistance since October of last year, all through November and the December high. So keep that in mind here as we head a little bit higher in dollar CAD. Also bring your attention to the fact that we have made a break of a resistance trigger here on the weekly charts. Again, nothing matters until the weekly close. So we'll have to reassess this tomorrow afternoon. But should that materialize into a break, again, you could see this thing continue to move higher. Any questions on dollar CAD or where we stand now? Let me just see what this looks like. Give me one sec. Huh. So the modified shift looks like it has a perfect touch and break of the 50 line. Here's the breach, acceleration, failure at the median line. Here, let me make this a little bit darker. Just to kind of show you what I'm looking at. So, perfect rebound off the 50 line, failure at the median line, the breach seeing acceleration, the pullback seeing a little bit of a dip, but here's the break higher. I don't know if you can follow this with me at home. It's a little bit messy, but today's close will be important. I could see a stretch into like 28.90 and then a pullback, but I want to see his close above that 50 line to give you conviction on a possible move higher. How can I clean this chart up to show you a little bit cleaner? We can probably drop these slopes at this point. I'll move that. Oh, move that 618. Okay. Feel free to take a snapshot of this, guys. I'll clean this up a little bit more, and maybe we'll throw it on tonight's update, but that's a slope I'd be interested in just because of the reaction that we got both along the median line on the pivots and the 50 line specifically. That's a perfect breach launching point, reversal daily candle off that region. So it is giving some credence to this slope. So just keep that in mind. Largely speaking, still looking a little bit higher here in dollar CAD. Okay, questions on the loonie. It's number 5. Number 6, Aussie. So the Aussie obviously saw a massive tumble. We've been tracking this one as well. Seeing a little bit of a rebound here today. Here's what Aussie looked like earlier in the week. The break, again, very similar to what we did with the euro dollar, right? Very clean break of the weekly opening range, shifted the focus lower in price. The first initial target was the 2016 November high. That was 77.78. Next level of interest is right here. Now, excuse me, in overnight trade, we did surge through it, but you're seeing a quick snapback here, and it looks like we're recovering below that region. That's the 618 retracement of the advance off the lows that we made in December of last year. Also, it's a very nice swing pivot. Okay, it's actually the 2016 yearly high day reversal close. It's a mouthful, but you can see resistance wicks there, resistance wicks there, resistance wicks there, break, acceleration, perfect support, break, acceleration, perfect resistance, breach, acceleration. Here we are now. So remember, these very low tolerance regions in price. Price does not like spending time here, right? It's either a run through or a reversal. You don't see a lot of dilly-dally around this level. That's why today I think it's going to be very important to see also, again, the close and how that looks. Now, note that momentum is right at 40. Okay, so if this is going to, give us some sort of corrective rebound, this would be the first area I'd look for. The broader trade still remains bearish on account of the monthly opening range break, but certainly I don't want to chase the lows from here. Here's what the intraday chart looks like, and here's what we look like again a few days ago. Right? So you saw the rebound off the 2016 high. That was a welcomed recovery. We were looking for resistance at 78.25. Didn't make it quite that high. Turned right ahead, about 5 pips ahead, and turned right around at 78.20. Again, taking out that initial break there, and we're trading here right now. Okay? Again, momentum coming right back from oversold. That's a near-term constructive reversal pattern. See if you can get the rebound a little bit higher towards those former lows. Possibly look for re-entry here. But at the end of the day, our bearish invalidation is pretty steady, okay, at the initial weekly opening range lows. 78.25, near-term bearish invalidation. A break lower, you're looking for 76.30, 76.45. Okay, and again, Aussie on the weekly charts does suggest that, again, you're coming into an area of interest here. And this is my problem with taking on new exposure here into the start of the March trade calendar month, guys, because a lot of these levels are at make or break zones. Right? And I can't sell into this zone. We're just opening up the month. There's weekly support here. The 52-week moving average is right in there. So again, it's one of those precarious situations where, patience pays. And let's start off the month on the right footing. Pooja says, I shorted Aussie on a break of 78 during U.S. session today. Left limits at 77.42. And went to bed, woke up with a nice 50 pip profit. Nice call, right on. Well, all I'm doing is helping you identify the levels, Pooja. You're the one doing the trade, so amen to that. I appreciate it, and nice play. Absolutely. I mean, the 78 handle was a gutsy call just to sell there, but on this rebound, there was the opportunity to try to make that move against that stop for 77.40, but nice call, well played. Yeah, and again, on this trade, guys, it's just a very clean cut, trade. Always try to keep it as basic as possible. You had a 618 retracement. You had former channel resistance, that purple channel that we were looking at. That break is what shifted the focus higher to start the week. Once we broke the opening range low, you look for former resistance as support. That's exactly what happened, right into that region. Now we dribbled lower, but here's the recovery. So ultimately, I do think you get a little bit more of a snapback here, but you do want to sell that. Look for a break below 77, okay, to open up the downside targets at 76.30, 76.40. But this is your sort of near-term support at this point. Questions on Aussie? And, sometimes it's just good to kind of take a look back at near-term price action and just look at this one touch, two touch, speculative, three touch confirmed. We turned from it again last Friday. Once we broke below it, where did we find resistance? Right at that same slope, and then move lower. Okay. That is numero 6 on the session. Next up, if you have any questions, guys, feel free on Aussie. Next up is dollar, yen, and Kiwi. So the abomination, we came into the week, and this is actually was one of our favorite plays from last week. We had some really nice short exposure on this decline. If you guys recall, the last target was right here between 106.44 and 106.38. I had my limit towards the upper bounds of that. We got limited out early in the week on that dip. Once we rallied again, we talked about 107.45, 107.50 being our initial resistance, with 107.84 as our bearish invalidation. It was a perfect play. Came right into the median line, failed there, okay, right off the bat with a 2-hour reversal bar right after. Another poke there, failed. We talked yesterday about the 618 retracement. That was the target for the short. So I got out, but at the end of the day, I still think the levels are pretty clean. Now, as far as dollar yen's concerned, the biggest issue is that the weekly opening range, unlike euro, unlike sterling, unlike dollar CAD, unlike Aussie, hasn't broken. That's partially due to the fact that you're seeing both dollar strength and yen strength start to materialize. Look at pound yen, and that's pretty obvious, right? Even euro yen. So the focus on this remains the same since the start of the week. It's a break of 106.38 on the downside to get resumption. Obviously, no one's going to argue that this is in a downtrend still, right? Or the breach above 107.45 at this point, I think, would unleash a little bit more of a recovery. In that type of scenario, you're risking a move all the way up back towards these swing lows, the 50 line, that takes you into like 108.46. So as for now, guys, the initial start of the week, we were looking for a short off this. Now that we've held the weekly opening range low, we're holding that range. Note that this thing is, it's not the cleanest, but I'll show it to you. We're basically like in some sort of near-term consolidation. In fact, if you take that low. Okay. Consolidation or triangle resistance highlights the same region we're looking at. Love it. Love it. The lower parallel or the consolidation support, even if we break that, keep an eye on 106.40. Okay, keep an eye on 106.40. That's the level we need to break. So all the focus that matters for dollar yen heading into the close of the week is either 107.50 break or 106.40 break to the downside. Obviously, from sort of an ideal type of scenario, these consolidation patterns typically are continuation. I've seen many that have been terminal for the trend. But most of the time, it's known as a consolidation pattern is a continuation. So again, the daily charts continues to highlight that 107.45 level as your resistance. Bottom line, it's exactly where we came in, pulled back, and there's the key support structure that you're looking for. Always did strange move. It's the only pair which didn't clear its monthly opening range. Absolutely, amen. I wouldn't say monthly opening range because the monthly opening range was massive. So, Iman, for this one, in my humble opinion, this was actually the break of the monthly opening range. And that's just because we opened the month just below resistance. So inherently, when that happens, your resistance level is the monthly opening range high. Once we pulled back from here, you see a strong rebound we made on the 6th. That was a decent opening range low for the month. And in fact, for the next 3 consecutive days, we tried to break and failed. This could be considered a break of the monthly opening range here. Drop to a late month low, and you're in consolidation. So when the monthly opening range like this is real stretch in the first 2 weeks of trade or 3 weeks, you just make a massive range. It becomes less of a operable type of play. Does that make sense, C-Man? But the focus from now, again, is bearish below the median line. Nothing's changed. If we break above the median line, look for the sterner recovery. But all things held constant, 107.45, 107.80, still sort of regions of resistance. You need to see it break below the low day close, 106.27, to get resumption. Triangles in the abomination usually do not end up being consolidation. Trust to break 107.50, it says. You know what? I should probably be expecting that, Pooja, because it is the abomination. Look, the range is the range, and until we clear it, I'm going to sit aside. We had some really nice plays on this last month. I don't want to sort of mess around with it. I have nothing but the utmost respect for dollar yen. Again, as I told you guys know the story, this thing massacred me really early in my years in trading. So I approach it always with the utmost humble type of attitude, because this thing is known to just rip faces. So look for that range break. Ideal scenario again that you see a hold or a break below this to get resumption. If we breach higher, look for that dollar recovery to really drive things here. In dollar yen, objectively speaking, guys, looking at this from the weekly standpoint, one other thing I want to note is, we were in a major range for the majority of 2017 since March, right? Support, resistance, support, resistance. This is the break of the downside of the range. You'd expect resistance there, right? Try to break it down to basics and keep it as simple as possible. So as long as we stay below that, can't really get too constructive on dollar yen yet. Questions on the abomination? Okay, that is number 7. 2 more to go, then we'll jump into your questions, guys, real quick. Kiwi made a pretty big break. Here's what Kiwi looked like earlier in the week. Okay. Oh, wrong report. Here's Kiwi. So this is from Sunday, right before the markets opened. We were talking about resistance, near-term resistance at 73. As long as you stay below the 50 line, that was our bearish inval. We basically wanted to see a break below 72.76. Now this was a big region because it was not only the 618 retracement of the advance, but also to open the week, you had a confluence there with the lower parallel. So we came into the start of the week, we ran right back into that spot, then we ripped higher. Guess where we failed before finally breaking the downside? We're now trading near here, guys, in Kiwi dollar. Here's what it looks like. Okay, there was the tag again, start off the week. We gapped right into it, bounced higher. The 50 line held resistance like a charm, specifically, on a close basis. Take this to a line chart. Boom. Doesn't get much cleaner than that. So on the pullback, you're looking for a basic objective break of the weekly opening range to get this thing confirmed on the downside slope. You got a pretty clear confirmation. Again, very little opportunity to be able to get back in. I'm not going to try to front and say I was in this. I wish I was. But the levels were super clean. You broke the lower parallel. 73.30 was the first target. 72.17 was the low day close so far for February. And there's the February lows, right? 38.2 retracement. This is the retracement of the entire advance from the lows that we made in 2017, specifically November. And here's the upslope again. Near-term resistance is right here. Bearish invalidation. The only thing that would put me bullish would be a break back above the objective weekly opening range low. That 618 retracement and the median line. That's the only thing that would put me bullish. At this point, I still think you're looking for the recovery to sell still. Here's Kiwi on a daily, by the way. Nice, perfect touch of the 38.2 retracement. 200-day moving average is just lower. So again, I'm not surprised to see a little bit of a recoil here. But this one, who was saying that? Eman? Yeah, Eman. This one is one of the majors that did not clear its monthly opening range, right? Here's your monthly open. I usually have a marker there. Here's your monthly open. You set a monthly opening range low early in the month on the 8th. You test the highs, and although you did breach, you did not see a close above the monthly opening range high. Here we are back again, monthly opening range low. So the focus is on a break of this massive region. I know it doesn't give us much help, but we need to stay in, we need to stay disciplined, specifically into the open of a new month, last month of the quarter, the first quarter of the year. I think we need to respect that break range. And I haven't been presenting to you guys the weekly charts just because, the daily charts, just because, again, I don't think it's all that clean. And I don't have a lot of clarity on it. I kind of get a little bit hesitant. So all things held equal, we've now come into a near-term support. We've come into the monthly opening range lows. I do think you look for exhaustion at one of these 2 points. A break lower from here, I don't have any scalp targets until 71, basically. And that's the 50% retrace. Also, one thing to keep in mind is if this is a downside break, this is one of the cleaner double top patterns that you've seen. Oops, I don't need that. And if we do see that break, a measured move of that double top, okay? One top, two top, break of the lows, a measured move of the run gives you a target down here at 69.20. Now that happens to coincide almost perfectly with the 2017 yearly open. So a little bit broader of a view, but that is what the technicals would suggest if we break below 71.85. Very simple. Very simple. And this, again, a lot of people will see double tops all the time. Whenever the markets are approaching resistance, all of a sudden you look on Twitter and there's 7,000 people calling for double tops. That's not how you play them, guys. The break of the neck, the break of the low, that is what gives you the measured move and the suggestive trade down into 69 and change. But until we get that break, it's simply a test of resistance and pullback. So looking for a possible rally to fade at the end of the day, 71.85, a break there. Got tons of downside room. Your first initial target doesn't come basically until the 71 handle, 71.08. Questions, comments, concerns on Kiwi. Last but not least, number 9 is Aussie Key. This one was actually one that, again, was a beautiful play. We opened the week noting that we had broken above descending channel resistance on Friday, saying, look, as long as you stay above the 107 handle, you have to buy pullbacks. It's a simple break of descending channel resistance. And again, a pullback into the former channel resistance, the 50 line could be a decent entry, but at the end of the day, above 107, you're really looking for a stretch into 108.20/108.31. It's a 50% retrace, a very nice pivot in price, and also you had a nice confluence there of the upper parallel and former trendline support in red. Here's what Aussie Kiwi looks like now. Aussie Kiwi here. There we go. All right, so excuse me. Again, here was start of the week. You pulled back. Okay, you didn't quite get into the 107 handle, but there's the turn. Break higher of the objective weekly opening range. Did see a spike into resistance right in between 108.21, 108.31. The high was 108.27. Perfect. And the pullback again coming right back into support. So at the end of the day, this has made a simple round trip. I don't necessarily want to fight this at this point because I think Kiwi and Aussie are pretty critical levels. So you could get some more chop. But at the end of the day, I still think you get some sort of near-term corrective bounce here. Here's the daily chart. So if we came into the lower parallel, obviously you can submit this as a false break, the 2016 open, that big pivot, obviously making a nice rally to the upside. Wouldn't be surprised if we see a little bit more of a consolidation here, if not a stretch into that resistance region. And the reason I think that is because if this is corrective, it could be just a simple corrective move. You look for one more high to fade. Other than that, you're coming to a big region. Even from a momentum standpoint, failure at 40 here, unable to really make a push below. Let me see the monthly open here. Yeah, so look, this is the January opening range, right? That didn't break until basically the last day of the month. And when it did break, it fueled that drop. Now, ultimately, we were looking for 106.26. We didn't quite get it. But look at the pullback and snap. Former yearly opening range low. 200-day, 52-week, moving average. That's still like 105.45. 105.45. Either way you look at it, guys. That's sort of your bearish invalidation. Let's just put it that way. And let's see if we have something cleaner besides this. Bear with me one sec. Now, this is way too premature, but I just want to see if this slope matches. And it matches pretty damn good. There's that 107.45 level, 108.45 level, excuse me. Again, keeps coming up as a target. So keep your eye on that. Ooh, nice pivot, support, break, false break, resistance, support, upper parallel, break of the median line, back to the lower parallel. And one other thing just to take a look at is the near-term decline from here. 108.60 comes up on that. And if we are to break higher here, guys, if this does rebound, just for argument's sake, it's way too early to work with this, but just for argument's sake, I'd like to see what the extension from here looks. And if you do that, see the 618. Okay, scratch the 618. Keep that 100. These are levels of interest right here. Whoops. Dependent on time. I'd be looking for exhaustion at a stretch into one of these regions. Okay. And that is Aussie Kiwi. So guys, those are the setups that I've been following on this side. Your questions. First, it was from Pooja. She had a question on Euro Kiwi, short from 169.17. Euro Key. Okay, haven't looked at this in a moment, so give me a sec, Pooja. Let me just get my bearings. Okay, so I remember why I'm not having been paying attention to this. It's been a kind of a chop fest here, and this was the formation that we've been sitting in all throughout 2017 trade. It was insane, ridiculous, accurate. To open up the year, we dropped into the sliding parallel, this extending off the late low that we made in February of last year. You got 1 touch, 2 touch, 3 touch, 4 touch. This is messy. And ever since the start of the month or, mid-month when we broke the lower here, it's been, I just don't know what to do with it. Is that a break of support? I don't know. You did get a close. So if I look at this objectively from like a line chart, it did close below. And we spent a couple of days there. When we rally back up, again, the 100-day moving average holding as resistance. So look, all you've been doing, here's your February open at 68.56, Pooja. My problem with this is that all it's been doing is just straddling the monthly open. That's all you've been doing. So, and that's from February, by the way. Obviously, we opened this month almost the same exact level. So for me, I'm looking for conviction of the downside break. I love that your stop is at break even, right? Is that what you said? Booked half profit, stops at break even. Okay, you booked a half at 68.66. Right on, right on. So here's what I can tell you that actually does support your situation here, Pooja. Right now, all things held constant, if the markets were to close at these regions, obviously we haven't even opened up US trade yet, but you are working on an outside daily reversal. Covers the entire previous day's session highs and lows, reversal pattern off resistance. So that obviously would be very supportive of the move that you're looking at, right? Just looking at this objectively from a daily chart. Intraday, I want to see if I can find you some structure because I just don't, I don't like how, you didn't get an acceleration on the break of this. You've kind of been straddling it. So let's see if we can't work this out and get a little structure to this decline. Yes, stops at break even. Wondering all out here or hold for more? Let me take a look here for a sec. So right off the bat, just by looking at this objectively, forget all the lines I have drawn, it does look like you're making consolidation pattern. Again, typically these consolidations are continuation patterns. So you would be looking for a downside break ultimately. But let me just look at this. Okay. Well, it's not the neatest consolidation, but this would suggest resistance here. Obviously support here. That's the weekly opening range low as well as a 236 retracement. This is the entire retracement from the advance off the 2017 low. Okay. Put that there. That's your bearish inval. And just one thing, Pooja, if this is going to be a corrective bounce for you to favor kind of like a hold on that short, it would be really sweet if this was 100% extension. Ooh, we turned just ahead of it. Okay, so look, I'm not going to dismiss that as a failure to complete a correctionary 2 equal legs up, because we're talking about like 9 pips, not even. And here's your weekly open. You're testing weekly open support right now. So here's the thing, Pooja. This is weekly open support. I would, I'd be doing something here. You just took profit, not too high, not too much far from where we are. So I wouldn't necessarily like prompt you to jump out of the rest, but I would have a pretty tight stop on it because you got a really decent entry on it. 69.17. So you're basically from just below that line that we were watching at 69.30. We can scratch that, by the way, at this point. Yeah, wouldn't be too surprised to see a bounce here. But I don't think there's necessarily anything here to prompt you necessarily getting out. And again, the outside reversal that we're working on the daily chart, keep a close eye on that. 67.85 is where the juice is, Pooja. If that level gives out, it's an objective break of the weekly opening range. And on the back of an outside reversal candle off resistance, might be a decent break to the downside. Might be a decent break to the downside. Now, my problem with that is what's going to fuel that, Pooja? Is it euro losses? We've been talking about euros coming into support. Or is it Kiwi gains? Kiwi's coming to support too, so that could see the bounce to drive this lower. So just keep that in mind on this. Hmm. That is interesting. Well, I'll just leave that line for you. It's not actually a big deal. But Pooja's saying, where would you keep stops for now? So if I was trading, just personally, in my humble opinion, Pooja, I would have the stop at break even. And I'd be assessing this in the near term. Look, if you see some pretty strong divergence, a suggestive move to the upside at this point is to kind of sit there and eat the loss on the way up. But I don't see anything here that's kind of screaming at you right yet. You know what I mean? Maybe, okay, you're getting some slight divergence. If you're really concerned about it and you want to play it more conservative, 68.77, that high that we just spiked into, And the lower parallel has been support, support, resistance. There's the break, resistance, and it's also a decent range low, right? So if you want to play it closer to the chest, Puja, I'd have a stop just above 68.80. But if you're looking to play the possible breakdown for a larger pullback towards the weekly opening range lows, then if that scenario, I'd probably keep my stop at break even. Does that make sense, Puja? Okay, one other thing I wanted to go over real quick, guys. Oh, I'm over on time. Yes, I'll keep half at break even and bring down the rest. Not a bad idea. Yeah, if you're working with multiple positions on that, definitely I'd be fading out. So, for example, if you were to break back above that high that we just made, back above the median line, sure, take out another quarter of the trade, right, and then leave the rest at stop break even. That's a good way to play it. It's a good way to play it. Gold. I just want to talk about this because I'll be putting a piece out later on daily effects for the weekly forecast, but I wanted to show you guys two key levels of interest for the gold trade. Specifically 1306, we're testing that now. More importantly, 1299 to 1301. Here's what the weekly daily chart looks like. Big region of resistance, okay? You have the 50% retracement of the entire ascent off the December lows from last year. You have the 100-day moving average. You have slope support, former slope support from back here, decent pivot in price, all converges right there at 1301. And the 100-day moving average, right? I already said that. Here's what it looks like on the near-term charts. If we take a pitchfork from the decline, 50 line has been a really clean pivot, hesitation, break, test again, failure, acceleration. Didn't quite get to the median line. Here we are again. The median line right here, alongside the swing lows that we made, swing highs that we made from back here in, what is that, October of last year, swing low from back here in January, and the objective, February opening range low. So this thing is at a big level. So, at 13, specifically 1299, a downside break there, you'd likely see this thing plummet. 1285 would be an initial target for the downside move in that scenario. But all things held constant, I wouldn't want to chase any lower from here. I do think you get some sort of near-term corrective bounce off one of these two levels. But ultimately, this was a very clean, again, kind of a objective weekly opening range break. So keep your eyes on gold. It's testing the monthly opening range lows. And if it gives out, would suggest you're opening the March calendar month with a downside bias, at least in the near term here for gold. And if the dollar does continue to rip higher, that would only further fuel the downside move here in bullion prices. All right, guys, we're going to wrap it up there. Again, stick around just an hour and a half. We have Jamie who's going to be up with the midweek strategy webinar. I'm not 100% sure I'll get a piece out tonight, guys. It is the start of the month, so I'm going to take a little bit more of a sidestep. If there's anything pressing, I'll put you an update out there, but it's tax day for SB, so we got a lot of work to do. That said, guys, have a great weekend. We'll keep you updated on SB Squawk, and as always, I will see you on Monday. Have a great weekend, guys. Cheers.